What actually happens when markets panic? Markets don't panic the way most people imagine. There's no alarm, no sudden announcement, no single headline that tells you, this is it. Instead, panic begins quietly in places most people never look. By the time it reaches the surface, by the time prices start collapsing and news anchors raise their voices, the real damage is already done. What most investors experience as a crash is actually the final stage of a much longer process. A process driven not by numbers alone, but by human behavior, trust, and fear. And once you understand how that process works, you start seeing warning signs long before the chaos shows up on your screen. Before we go deeper, if you appreciate calm, system-level analysis instead of noise and hype, take a moment to like this video and subscribe. It helps channels like the Silver Collapse Report continue breaking down what AS really happening beneath the market surface. Now, let's start with a simple truth. Markets don't collapse because prices fall. Prices fall because confidence disappears. Panic is not the cause. It's the result. The first stage always looks harmless. Liquidity tightens slightly. Credit becomes a little harder to get. Some sectors underperform. Analysts call it a rotation. Central banks downplay it. Headlines reassure everyone that the system is strong. And for most people, life goes on as usual. But underneath that calm, something important changes. Risk tolerance drops. Large institutions quietly reduce exposure. They don't sell everything, they just stop buying. Volume thins out. The market still looks stable, but it becomes fragile, like ice that hasn't cracked yet, but can't support much weight. This is where panic actually begins, not emotionally, but structurally. As liquidity dries up, small shocks have bigger effects. A weak earnings report, a bank rumor, a geopolitical headline. In healthy markets, these events barely register. In fragile markets, they cause outsized reactions. Prices swing more than expected. Volatility spikes for short bursts, then calms again. Each time, confidence erodes just a little more. Most retail investors don't notice this phase. They're trained to watch prices, not market structure. They see dips as buying opportunities, because that's what worked before, and for a while it still works, until it doesn't. The next stage is denial. This is where panic becomes psychological. Investors start hearing conflicting signals. One day markets rally, the next day they drop sharply. Experts disagree. Headlines contradict each other. People don't know whether to feel optimistic or worried, so they do nothing. This is dangerous, because uncertainty is more corrosive to markets than bad news. Bad news can be priced in. Uncertainty cannot. Behind the scenes, leverage becomes a problem. Modern markets are built on borrowed money. Hedge funds, banks, even governments rely on leverage to function. When prices move against leveraged positions, margin calls appear, and margin calls force selling, not because investors want to sell, but because they have no choice. Forced selling is the engine of panic. Once forced selling starts, markets behave differently. Rational decision-making fades. Assets that normally have nothing to do with each other start falling together. Stocks drop, bonds drop, even safe assets shake. This confuses investors further because diversification suddenly stops working the way they expected. This is the moment when panic becomes visible, but still misunderstood. Most people think panic is about fear. In reality, it's about urgency. People don't sell because they're afraid of losing everything. They sell because they need liquidity now, to meet obligations, to cover losses elsewhere, to survive. And here's a critical detail that rarely gets discussed. By the time panic reaches the public, insiders are usually already positioned. Institutions with access to liquidity wait. They let forced selling push prices down. Then they step in, selectively. This is why crashes often include violent rallies. Sharp upward moves that convince the public the worst is over. These rallies are traps. They create false relief. People re-enter markets too early. Confidence returns briefly. And then another wave of selling hits, often harder than the first. This is why real market panics feel chaotic and emotionally exhausting. There's no clean resolution, just waves of hope and despair. Throughout history, this pattern has repeated again and again. It happened in 1929, it happened in 2008, it happened in countless regional crises that never made global headlines. Different triggers, same psychology. Now let's connect this to something deeper. Markets don't exist in isolation. They're part of a broader financial system. Banks, currencies, debt markets, and payment networks. When panic reaches a certain intensity, it spills over, credit freezes, banks become cautious, lending slows, Businesses pull back, consumers hesitate, and suddenly a market panic turns into an economic problem. This is where policymakers step in. Central banks respond with liquidity, emergency lending, rate cuts, asset purchases. These actions often stabilize prices temporarily. And when markets rebound, many people assume the crisis is over. But stabilization is not the same as repair. In fact, aggressive intervention can create a more fragile system later, because it teaches markets to expect rescue. Risk builds, leverage grows, and each new intervention becomes less effective than the last. This brings us to assets outside the immediate financial system. During periods of true panic, investors begin asking a different question. Not what will go up, but what will still exist if confidence fails. Historically, that's when attention shifts toward assets that don't rely entirely on counterparties or promises. Gold and silver have played that role for centuries, not because they magically rise in every crash, but because they represent something different. They're signals. When demand for them increases sharply, it often reflects stress elsewhere. However, modern markets complicate this relationship. Paper claims, derivatives, and leveraged products can distort price signals. Physical availability and market pricing don't always align, especially during periods of extreme stress. This is an area we'll explore much more deeply in upcoming videos. For now, the key takeaway is this. Market panic is not a single event, it's a process. One that begins quietly, accelerates invisibly, and only becomes obvious when options are limited. By the time everyone agrees that panic has arrived, the most important decisions have already been made. This is why understanding behavior matters more than predicting headlines. You don't need to know exactly when the next panic will start. You need to know how panic behaves so you can recognize it early and avoid being forced into bad decisions. At the Silver Collapse Report, that's exactly what we focus on. Not fear, not hype, but patterns. In the next videos, we'll break down how precious metals respond during real stress, how stock markets send warnings long before crashes, and why central banks struggle to maintain control once confidence begins to slip. If you're watching this, you're already ahead of the curve. Stay calm, stay analytical. And remember, markets don't punish ignorance as much as they punish late reactions.